Hi, welcome to this podcast where I'm going to be looking at break-even analysis. It's an introduction to break-even analysis, and then I'll do another video which will look more specifically at the calculations. Quick overview about what we're going to be looking at. What we're going to be looking at is a way of comparing costs and revenues of a business, and also calculating how much output a business needs to make to ensure that its costs and revenue are the same, i.e. it is not making either a loss or a profit. Hopefully you'll already be aware of the different types of costs in a business. You've got your fixed costs, which are obviously fixed. They do not change with the level of output. You have got your variable costs, which are things like the materials that go into making a particular product, and they will increase in direct proportion to your level of output. And then you've got your total costs, and the total costs are just your fixed costs and your total variable costs. And the final thing we need to think about is our total revenue. So here revenue is $40 per unit. So every time we sell an extra unit, we would add an extra $40 onto our total revenue. And what you will need to do on an exam question, if you're asked to do the graphs for this, is first of all do a little table. And what I would ensure that I would do is I would do at least 3 data points along the graph. In your exam, it will be a linear graph, so everything will be straight lines. But just doing 2 data points, if you make an error in plotting the second data point, for example, then the lines will be in the wrong place and you will lose marks. Okay, so once you've done your table, then we need to do a diagram, and we need to label the diagram correctly. Now in your exam, you will put what each line corresponds to alongside the line. Here, because I've done this all on a computer, there is a little legend there telling you what each line corresponds to. Very often you don't need to draw particularly this line, which is the total variable costs. You will always have to draw the total cost line, and you will always have to draw the total revenue line, and you may or may not be required to draw the fixed cost line. Don't forget to do all the basic things that we always do on a diagram, because there will be marks for it. So there should be a title for the diagram or the graph. The x-axis is always going to be output in units, and the y-axis will be costs and revenues, and you should use the currency that you are working in. So that would be pounds, for example, or dollars, or maybe if you're in somewhere like Kuwait, then that would be the KWD. Okay, now once we've got the basic lines drawn, and for my students, you'll all be A-level students, and you will have all done maths at IGCSE, so this bit shouldn't be too much of a problem. And we now get on to really the key points that we are going to look at, and things that in an exam they will expect you to identify. And we'll start with the simplest one, which is the break-even point. And the break-even point is the level of output where total revenue equals total costs. So in your exam, you will look for that point where your total revenue and your total cost curve intersect, and you will put a line down to the x-axis and label that as the break-even point. And you may also be asked to identify the level of output from your graph. And on my graph, it is 5 units because it's halfway between 4 and 6. The other really common one that you are asked to identify is what's called the margin of safety, and that is a measure of risk. And your margin of safety is the difference between the planned output and the break-even output. So in this case, it's going to be the difference between 10 and 5. So the actual break-even point here is 5 units. And we would label that with a line which is parallel to the x-axis, and make sure it's clearly identified as your margin of safety. Right, the next two are a little bit more unusual, but we'll do the break-even revenue next, because that's more common than the margin of safety revenue. And the break-even revenue is the revenue which corresponds to the break-even point. So what sales in terms of pounds or dollars in this case you need to achieve to make sure that the income of a business exactly equals the outgoings or the costs of the business. And again, we just draw a line which goes, in this case, parallel to the x-axis over to the break-even revenue, and label it on the diagram as break-even revenue. And in the case here, the break-even revenue is going to be $200. Okay, and then the very final thing that we, I've only seen this once in an exam, is to work out the margin of safety revenue. And the margin of safety revenue is the difference between the revenue expected by the business. So in this case, we're planning to sell 10 units. We expect the revenue to be 400, and the break-even revenue, which is 200. So the break-even, so the margin of safety revenue is going to be $200. And if we're going to mark this onto a diagram, then we would do a line which goes parallel to the y-axis, okay, from the break-even point up to the level of output that is planned and the revenue that corresponds to this. And we need to, again, make sure we label it on the diagram. The labeling is really important because there is normally a mark for each label. Okay, a couple more things that you may be asked to put onto a diagram. You've got the area of profit and the area of loss and the angle of incidence. Okay, the area of loss is straightforward. It's the area between the total cost curve and the total revenue curve, okay, below the break-even point. So it's this area that's in pink on my diagram. And what you would do in an exam is hatch it or make sure it is shaded and clearly identified, and again label it as an area of loss. And conversely, the area of profit is the area between the total revenue curve and the total cost curve above the break-even point. So it's this area here in blue, which again you should shade or hatch in on your exam question, and again make sure we label it as the area of profit. And then the final thing that we need to be able to label is the angle of incidence. And this is the angle between the total revenue curve and the total cost curve. So if you can see this in here, and that's a measure of risk. And there are two things that we use to measure risk. One is the angle of incidence, and the other is the break-even point. And the other is the margin of safety, sorry. Okay, and risk is how sensitive a business is to small changes in the factor input, leading to a profit becoming a loss for a business. So for example, if you look here at our margin of safety, the margin of safety in the example that we've done is 5 units or 50% of the expected output. Now, normally a business would hope that its budgeting process is accurate to within 50% of planned output being achieved, and therefore there would be a high degree of confidence here that we would achieve the required sales and therefore output to ensure a profit is made. If the planned output had only been 6 units, then a 16% fall in sales would have resulted in this business becoming a break-even business, and then any greater fall in sales, it would have made a loss. Okay, so therefore it would be quite likely if they've made a small error in their planning that this business would be a loss-making business. And with the angle of incidence, I've done a little diagram here to show you how the changes affect it. I've done 2 scenarios. Okay, one where the revenue is still $40 per unit, but a second one where the revenue is planned to be $80 a unit. And what that does, it makes the angle of the line between your costs and your revenue become much steeper under the second scenario. And what that does, it makes the business less sensitive to changes. So, for example, here, automatically, if I had a relatively small change, for example, in the revenue, then quite quickly that the revenue curve would fall below the cost curve. So revenue per unit falls by a small amount, and what that does, it means that the break-even point moves a long way out to the right or requires more sales. Whereas if the curve is quite steep, then a small change in the revenue per unit will lead to a relatively small change in the break-even point. Okay, so that's where risk comes in. Okay, what I will do for those of you that I teach, there will be some questions set on Google Classroom for you to draw diagrams and then to label all of the required elements on the diagrams for me to have a look at to make sure you can do the basic diagrams. Okay, what I would also like to cover very quickly are some limitations of break-even analysis and also the advantages of it. Okay, the first thing is it assumes all production is sold and that inventories do not change. So very quickly, just to explain that, it assumes that output and in units and revenue in units are the same number. It doesn't assume that they make 10 but only sell 9. It assumes that they make 10 and sell 10. Okay, it is relatively difficult to apply to a firm that makes more than one product, and that's because your revenue curves are likely to be different if you sell more than one product. So it depends upon the mix of products that you are selling as to how the line would look, and also different products have different variable costs of production. It assumes that all costs are fixed and variable, and lots of costs in a business, for example, the depreciation on machines depends upon the level of output and therefore the number of machines that you need. It is possible to do it for what are effectively semi-variable costs. Semi-fixed costs. And also semi-variable costs, to be honest. Okay, but here we've got semi-fixed costs, and what you can see is actually the costs will go up as a step, and you will end up with multiple break-even points. In the real world, your costs, particularly your variable costs, may not be a straight line. So, for example, at some point, I may require my workers to work overtime. And if I do that, the graph will become steeper for the variable costs at some level of output. It doesn't allow for things like sales. So again, if we have a sale, this assumption that our total revenue curve is a straight line may not be correct. It doesn't allow for external factors that may impact on a business. So, for example, we still don't know if a recession is going to reduce demand quite significantly. An over-reliance may lose managers to stop focusing on reducing costs and just to assume that costs are always related to the level of output. And in reality, things like fixed costs can be controlled by a business. So, for example, you can look around and maybe buy the same machine for less, and that would reduce the fixed cost per year of depreciation. So managers should still be looking to try and reduce all costs of a business. And a sort of catch-all with a lot of management accounting is it's based on budgets. We do this at the start of the financial year, before the start of the financial year, and therefore the quality of the information affects how accurately we calculate the break-even point or the margin of safety. And if the assumptions are wrong, then the model itself will be wrong. However, there are lots of advantages. Most businesses do break even, and they find a way around these problems. It's a very easy concept for people to understand. Most people, if you said what's break even, they would say straight away, it's where your costs equal your revenue. You're not making a profit or a loss, even if you've had no training in finance. And also, the graphic representation of the model is very easy for people to understand. If we don't sell 10 units, we only sell 4 units, the business will make a loss. People will ultimately have to take pay cuts or lose their jobs. It's a very easy model to change and to use what are called what-if scenarios. So, for example, when I looked at the change in the angle of incidence, all I needed to do was to change my assumptions for my revenue per unit, and it would automatically graph and do the calculations. It allows comparisons of different options, e.g. where we've got a choice of buying different types of machines. So you could do 2 break-even analysis, one for machine 1, one for machine 2, and you could look at how that affected the break-even point and also the long-term profitability of the business. And then what you would be able to do is compare the options and decide upon the one which probably has the lowest risk possible, but also maximizes the expected profit. As we've already mentioned, it can be used to assess risk, and risk is very important when we're doing any of these tools because they're ultimately being used to budget for things and to make predictions on the future. And a lot of things are risky for a business. So, for example, particularly sales and how much you can sell sales for is very, very difficult for a business to assess because there are so many external factors involved within that. And it can be used to model the effect of internal, and that should say, and external. External and internal factors changing. So what would happen to a business if demand externally fell? What would happen to a business if we, for example, agreed to pay our workers a pay rise, and how would that affect profitability? Right, hope that was useful for all of you. Obviously, the students that I teach, please email for any problems. You will have some questions, a couple of questions to have a go at the end of the spreadsheet that I share with you. And thank you very much for taking the time to listen.